stop pushing it, it's hot, right?
No, you just have to tap it, it's on, and then tap it, it's off. You don't have to hold it. Okay, if you guys are ready, you can go ahead. This is the Police and Fire Pension Board. This is the Police and Fire Pension Board. Call to order. We have Member Alternate O'Connor.
Present.
Member Alternate Smizer.
Present.
Member Schwartz.
Present.
And I'm Member Sue, I'm here. And would one of you want to read the acknowledgement? Go ahead.
Which one is it? That one right there?
No, the one, no, yeah.
This one? That one? You can read it. It's right there. The City of Albany recognizes that we occupy the land originally protected by the Confederated Villages of Lejeune. We acknowledge the genocide that took place on these lands and must make strides to repay the moral debt that is owed to this indigenous people, specifically the Ohlone tribe. We thank them for their contributions, which have transformed our community and will continue to bring forth growth and unity. The City of Albany commits to sustaining ongoing relationships with the tribe and together build a better future for all that now make this their home.
Okay. Then consent calendar. Does anyone have any questions on consent?
Move to approve.
Oh, I have to check to see. Okay, no public attendee. Any second?
Second.
Thank you. Member Alternate O'Connor? Yes or no? Because you second to approve.
Do you want me to say my name? Yes.
Yes.
Sorry.
Member Alternate Smizer?
Yes.
And then Member Schwartz?
Yes.
And I vote yes, so it passes. Then we have public comment. There's no one in audience here, and there's no public attendees virtual. Next one is announcement. Any announcement from staff or from board members? No? Okay, reports. Dewey? Sorry, I'm having a little technical issue, so, okay. Give me a minute. Sorry. Usually there's not a problem, but it's not. Hold on a sec. say next slide, because they're,
Okay. Next slide, please.
Jeremy, next slide, thank you.
Next, please. So this is a quarterly report from CIBC, the account that we manage for the pension. This is, on this page is the current allocation of the account at the end of the year, so the end of quarter four 2023. In the account, we had $285,000 in cash, about 12%, about $945,000 in bonds, fixed income, or representing 41%, and about close to $1.1 million in equity in stock, roughly 47%. Just as a reminder, this portfolio has been managed with a balanced objective, about 50% bond, 50% cash. The reason we had a little bit more cash this year, we had raised the cash, and it's sitting in high yield money market fund for the purpose of quarterly distribution to the operating account. Next slide, please. For quarter four, this is a change in portfolio value. Starting the quarter, the value was $2.169 million. No addition or withdrawal in the last quarter. The income received was $33.8 thousand, $33,000. Capital appreciation, this is a change in the investment, the change in value of the investment, about $121,000. Total return is the income and the capital appreciation, close to $155,000, representing the ending market value of the account, $2.324 million. Next slide, please. This is a change in market value since inception. So we started managing this account for the pension in 2009, September 30, 2009, starting close to $11 million. Over the years, total withdrawal was over $15 million. Income generated from the investments throughout the 14-year period was close to $2.4 million, and capital appreciation was a little over $4.1 million. So total return over those years, $6.5 million. If we net them all out, that's the value of the portfolio at the end of 2023, $2.324 million. If you go to the next slide, this is the performance return for the portfolio. So for the year of 2023, the portfolio returned 11.6, close to 11.59, close to 11.6%. Last 3 years, on average, about 5.4%. And since inception, so since September 2009, closer to 7%, 6.97%. If you drill down, last year, bonds went up about 7% on average, and the stock fund went up about 17.48%. So average return for the year for the total portfolio came out to 11.59%. Any questions so far? Go to the next tab, next slide, please. This is a look back of financial market last year, last 3 years, and last 5 years. So if you look at on this table, U.S. stock, this is just the S&P 500. It's not representative of the entire market. But last year, the S&P went up 26%. Last 3 years, up 10%, and last 5 years, up 15.7%. It's been a very strong stock market. Considering in 2022 we had a significant sell-off, a gain last year. Effectively, at this time, the market has erased all of the sell-off of 2023, and we just reached new high yesterday, on Monday, for the overall stock market for the S&P. If you look at in the same period, international underperformed the U.S. The last 3 years, developed international stock was up 4%. In the portfolio of the pension, we don't own any international stock. No emerging market as well. Emerging markets, the last 3 years actually went down 5%. The interesting thing that I like to point out is if you look at the bonds portion, U.S. Treasury and intermediate corporate and government bonds. Last year, it went up about 5% on intermediate bond. Long-term Treasury went up only 3%. But the last 3 years, long-term Treasury went down 11%. And intermediate bonds, corporate and government bonds actually went down 1.6%. That was the reason, the effect of interest rate hike in 2022. We had, up until the end of 2021, effectively 0% interest rate, and in 22 and early part of 23, total of 5.25% rate increase from the Fed. That took down prices of most of the bonds that accumulated back in 2021. So that's the effect of interest rate hike. The other thing to notice, commodity. So last year, commodity is an index that investors look at as a guide of inflation for, looking forward. Commodity went down close to 8%. Oil went flat, slightly down. Gold actually went up, but in 2022, gold didn't really do anything. So a lot of investors use gold as a guide for inflation hedge. It didn't work the same, but there's a little bit of that in the market, but it's not really a true hedge of inflation. But the good guide for us to look at is the trend of commodity is trending down, which is consistent with our view of inflation has been on the way down this past year. Next slide, please. So this is our CIBC investment themes for 2024. Just look back, last year, U.S. economy had performed very well. Going into last year, the previous quarter that we discussed, we were cautious about the economy and the outlook for the market. And the key thing for a lot of investors, including us and strategists, was the Fed raised interest rate 5%. You cannot have an economy with a 5% interest rate and not slow down the economy. That's the goal of the Fed, to slow down the economy and fight inflation. They did fight inflation, and they did, up until this point, without a recession, we have to admit that the Fed has done a very good job navigating the very difficult environment back in 2022 and early part of 23. Bring down inflation, at the same time, not significantly raise unemployment rate, so that we still have a very strong and healthy labor market. That translates into a very strong economy going into this year. We believe that the rate hike cycle for this cycle is over. The market is expecting the Fed to start cutting interest rate in May of this year. Actually, there's a 60% chance the market put for a rate cut in March, and an 80% chance that a rate cut will start in May. As of today, still, the market put there's a good chance of 5 rate cuts for this year, would translate to about 1.25%. Our firm believe that that's a very aggressive expectation of the market. We do expect the Fed to start cutting rate, but with strong economic activities, the economy continues to, our economic activity continues to slow down, but we don't expect it to slow down significantly into a recession. And with a very strong labor market, we do believe the Fed will look strongly at the data, and 5 rate cuts or 1.25% by the end of this year is very aggressive by the market. The next thing, Treasury yield curve, you probably heard the last couple of years of inverted yield curve, which means short-term bonds yield is higher than the long-term bond yield. That's historically, if you have an inverted yield curve, it's almost 100% chance that recession would happen within 18 months. We have been having this inverted yield curve for over 18 months. We haven't been in a recession, so you could say this cycle is different, and it is different because a lot of the inflation that we had back in 2022 was not necessarily because of demand from the consumer, but more of the constraint in supply. So when supply, come back from the COVID, supply constraint, when supply came back, it's kind of eased out, and it didn't really affect on the demand side. And with a very strong labor market, we kind of eased through this past cycle. Doesn't necessarily mean that we won't hit a recession this year. There could be a lot of things that cause the economy to slow down and put us in a recession. It's unlikely at this point, now that we look at the data ahead of us, or the data before us and expecting the data ahead of us, it's unlikely for us to head into a recession. What translate is right now, last year the S&P U.S. equity went up about 26%, like I showed in last slide. Valuation on the S&P right now is fairly expensive. What we are cautious is back in 2021, the S&P, the stock market in November of 2021, valuation was right around this time. But that was at the time when interest rate was near zero. Interest rate now is at 5%, 5.25%. But valuation on the S&P, looking at the price to earnings ratio, forward price to earning ratio at 20 times, it's fairly expensive. So it's not extremely high, but it's on the expensive side. So our expectation is for this year, we do expect the market to go up, but not in the same magnitude. And we do expect in the first half of this year to have some volatility, consider what we had last year. Basically, the last 2 months of the year, the market went up 10%. So there are a little bit of profit taking, or volatility is expected. In terms of the overall structure of the market, large cap stock is very expensive, or fairly expensive, I wouldn't say very. Small cap, mid cap is more reasonable, and outside of the US, valuation is extremely low versus the US. There are a lot of risks outside of the US, and that's the reason for the difference in valuation. We don't invest outside of the US for this particular account, but it just, to put in reference where we are. Next slides, please. And I'm just going to go over a few slides, and should be it. So I talked about the U.S. economy a little bit. In 2024, the theme is lower inflation and slower growth. I mentioned earlier, we saw signs of a cooling off labor market. So there's the last few weeks, we've seen across the country unemployment application in most states went up, but it's actually a normal healthy signs of the economy that you went through a strong holiday season, there's a little bit of structural changing. It's not significant. It's not significant yet, but it's just a healthy sign. And the data is showing that labor is cooling off. We're not in a very tight labor market where you have opening, but you don't have labor to fill. So that's a good trend that the Fed wants to see to confirm a rate cut later this year. Next slide, please. Another interesting thing about U.S. economy, U.S. oil production going into 2022. Back in 2018 and 19, U.S. was the largest exporter of oil product in the world. And for a few years during COVID, we cut production and we became the second. But now, at the end of the year, 2023, U.S. had become again the largest exporter of oil products. And that contributed to the decline in oil prices when we had OPEC cutting production last year. So that also have a positive effect on bringing down inflation. Next slide, please. 2024 is an election year. An interesting statistic that we try to bring up, the market right now is pricing about 50% chance of each, on both sides, President Biden getting reelected, and on the Republican side, whoever wins the nomination, likely Donald Trump, it's a 50% chance that the Republican would take back the White House. What is interesting to us is since 1952, there were only 3 times during an election year that the stock market went down. And all 3 times, we didn't have a sitting president running for re-election, meaning that in every year where we have a sitting president running for re-election, the stock market went up. And that kind of understandably, it's their economic policy. The White House can do a lot of things or the party of the incumbent party can do to boost the economy in an election year. So that could happen. Doesn't mean that that's going to happen, but historically it shows that in an election year, stocks tend to go up. Next slide. So I'm just going to go over this slide real quick, and I think that's, let me see, that should be it. Federal Reserve, while I mentioned the market is expected the Fed to start cutting rate this year, and expectation is for 5 rate cuts this year. We are still in a more restrictive money policy comparing to what we had before 2022. Remember, for almost 10 years or 13 years, we had 0 interest rate. Since the financial crisis 2009, we had 0 interest rate up until about 2018. The Fed started raising rate, and then COVID happened. They start cutting rate again to 0. So for the 14 years, effectively, we were in a very low rate environment. But before that, before the financial crisis of 2008, normal market interest rate was right around where we are. So, or slightly lower, but it was for Fed funds rate, 3% to 3.5% was quite normal. So while we remained restrictive, the market can expect the Fed to cut rate. We're still, more like heading back to normal than, what we were. It felt like, we had been in a very restrictive environment, and, mortgage rate went up to 7.5%, 8%, auto loan went to 7%, 8%. It's actually getting back to normal historically. It's still kind of on the high side, but when rate cuts happen this year, things can go back to more, you can expect mortgage rate to be in about 6%, and auto loans around that area. That's kind of a normal economic environment. So I think that will do it for me. Can we move to slide number 8, please? Next slide. I'm sorry, at the bottom. Next slide. Next. A couple more slides, please. One more. There we go. So I talked about a little bit about U.S. equity. This chart kind of show where what I was talking about earlier. The last 2 years, we went through a significant sell-off and then a bounce back the following year. We got back to where we were exactly in January 2022, and market valuation right now is exactly the same as it was back in January of 2022 at the high before the sell-off happened. Kind of over the last 2 years, we have a reversal of a bear market. Valuation is quite expensive right now, but it shows the kind of the long-term investment thesis just stay the course. And the last 3 years, for the purpose of distributing cash, we maintain the balance of the portfolio every quarter. Once we need to raise cash, the equity piece went up. We raised cash from equity. If the bond side went up more, we raised cash from bonds. So maintaining that discipline over the long term paid off for the pension portfolio. And that is it for my presentation today. Any questions, concern? So in terms of, you may not know right now, but in terms of cash needs, do we know if we need any cash from the portfolio for the next, this coming quarter?
So based on what I've looked at, the pension payments at about 80,000-ish, and the cash holdings, so as long as we maintain that cash, we should be able to carry ourselves through just about through the quarter.
Okay.
That would take us pretty low on the cash side, but, so there's a question of whether if there are significant market developments over the course of the quarter, we should probably talk about them from the city treasurer to, the investment manager. But otherwise, I think at 285 on the cash side, that's pretty much what we should need. We don't anticipate any increase in anticipated needs for pension payments.
Okay. Okay, sounds good. Then I'll just wait for instruction if when you need cash and we can transfer over. Typically, in previous year, we transfer every quarter 300,000 from the pension account over, but that's why we maintain that cash aside. All right.
Yeah.
If you don't have any questions, then that's it for my presentation today.
Yeah, and there's no public comments. So.
Great. Thank you.
Thank you. Yeah, if we have any need, we'll contact you.
Sounds good. Thank you.
Thank you. And next item is organization of an officer. Due to the city council appointee unable to attend today, I would move to table this item until next meeting. If that's okay with you guys, someone can second.
I'll second that.
So, member alternate O'Connor,
Yes.
member alternate Smizer,
Yes.
member Schwartz,
Yes.
and I vote yes, so that motion passes. Thank you. Future agenda items, do you guys have any future agenda items for next meeting in April? Other than the election of officer, obviously. Okay, then the next meeting is on April 23rd at 3 o'clock, and the meeting is adjourned. Thank you.